Here's a statistic that sounds mathematically impossible the first time you hear it. The average retail investor dramatically underperforms the very market they are investing in. Not slightly, dramatically. Over long periods of time, the stock market historically trends upward. Entire indexes compound for decades. Massive fortunes are built simply by staying invested long enough. And yet millions of beginners still lose money, quit investing entirely, or earn returns so weak they barely outperform inflation, which creates a bizarre contradiction. How can people fail at something that statistically goes up over time? How can beginners enter a market designed around long-term compounding and still walk away convinced investing doesn't work? The answer is uncomfortable. Most beginners are not actually investing. They are participating in what I call the stock investment fantasy, a psychological illusion built from social media clips, YouTube thumbnails, brokerage app notifications, and success stories carefully stripped of time, pain, boredom, and failure. The fantasy says investing should feel exciting quickly. The fantasy says smart people beat the market. The fantasy says a few good stock picks can change your life fast. The fantasy says successful investors constantly know what's happening. But real investing feels completely different. Real investing is slow, emotionally uncomfortable, often boring, sometimes humiliating, and worst of all for beginners, real investing usually provides almost no visible rewards in the beginning. That's the part nobody prepares people for. A beginner invests their first $500 expecting momentum, then checks the account 3 weeks later and sees they made $11.42 or lost $37. Suddenly the fantasy starts collapsing because emotionally, the beginner expected transformation. But mathematically, compounding barely looks like progress at first. And this single misunderstanding destroys more investing journeys than market crashes ever do. Most beginners do not quit because investing is impossible. They quit because reality violated the fantasy they secretly expected when they started. I'm Mike, and on this channel we break down the financial systems that actually work in real-world scenario, especially the ones nobody taught you. And hi. Remember to hit the subscribe button below to stay informed on our future videos. Let's dive right in. Right now, millions of first-time investors are entering the stock market through the most psychologically dangerous environment retail investing has ever created. Because modern investing no longer feels like long-term ownership. It feels like entertainment. Brokerage apps now look almost identical to social media platforms. Bright colors, instant notifications, daily percentage changes flashing constantly. Trending stocks, leaderboards, most active tabs. Entire online communities obsessing over what happened in the last 4 hours. And all of it quietly trains beginners to think investing is supposed to produce continuous stimulation. The average beginner now enters the market carrying expectations shaped by viral success stories rather than actual compounding timelines. They hear about people turning a few $1,000s into millions. They see screenshots of overnight gains. They watch influencers discussing winning stocks every single day. And without realizing it, they begin measuring investing against entertainment-level emotional standards. That creates a massive psychological mismatch, because real long-term investing contains enormous stretches where almost nothing exciting appears to happen. Weeks, months, sometimes years of slow, unremarkable progress, and modern attention spans are not built for that environment anymore. Especially when beginners can open their phone and instantly compare themselves against someone claiming to have made $40 in trading options in a week. This is where the collapse usually begins. The beginner starts with patience, then impatience slowly enters the system. They begin checking prices constantly. They feel disappointed by slow gains. They become vulnerable to riskier strategies promising faster outcomes. Eventually, they stop investing and start chasing stimulation disguised as investing. This is why so many beginners bounce between crypto hype cycles, meme stocks, day trading strategies, options trading, and hot picks without ever building meaningful long-term wealth. They are searching for emotional acceleration, not mathematical compounding. And the data around investor behavior reveals something extremely revealing. The more frequently people trade, the worse their long-term performance often becomes, because emotional activity and wealth creation are usually moving in opposite directions. The beginner thinks action creates results, but in investing, excessive action often destroys results. Meanwhile, the investors quietly building wealth usually look boring from the outside. They automate contributions, ignore short-term noise, continue buying during downturns, and allow time to do the heavy lifting most beginners expect excitement to accomplish. But this creates another psychological problem. Boring strategies are extremely difficult to market online. Nobody goes viral by saying, "I consistently invested into diversified assets for 22 years while ignoring emotional impulses." That story doesn't trigger dopamine. It doesn't create urgency. It doesn't feel cinematic. So beginners keep consuming highly emotional investing content while quietly losing the patience required for actual wealth creation. And eventually many of them conclude the market itself failed them, when in reality, they were trying to force entertainment speed rewards out of a system built entirely around long-term delayed gratification. What's happening to beginner investors today did not appear randomly. It was built step by step over decades. And once you see the sequence clearly, the modern investing psychology crisis starts making perfect sense. The first domino was the democratization of investing itself. For most of history, investing felt distant and inaccessible to ordinary people. You needed brokers, large amounts of capital, phone calls, paperwork. The process felt slow, formal, and psychologically serious. That friction unintentionally protected many people from impulsive behavior. Then technology removed the friction. Brokerage apps made investing instant. Fractional shares allowed anyone to buy stocks with almost no money. Commission-free trading eliminated transaction barriers. Suddenly, investing became available to everyone at all times, which sounds entirely positive on the surface. But then the second domino fell. Social media collided with finance. And this changed investing culture completely, because social media rewards visibility, speed, emotional intensity, and extreme outcomes. Slow compounding does not perform well in that environment, but explosive gains do. So the internet gradually stopped presenting investing as long-term ownership and started presenting it as high-stakes opportunity hunting. Every bull market created new financial celebrities, teenage millionaires, crypto overnight success stories, day traders turning small accounts into fortunes, options traders posting six-figure screenshots. And algorithms amplified these stories endlessly because emotionally intense content spreads faster than disciplined behavior ever will. Then came the third domino. The rise of hyper-short-term financial feedback loops. People no longer evaluate investing yearly or even monthly. They evaluate it hourly. A beginner can now watch their portfolio fluctuate every few seconds directly from their pocket. That constant visibility changes behavior psychologically. Humans are not emotionally designed to experience real-time fluctuations on long-term assets all day long, especially beginners. Every red day feels personal, every dip feels threatening, every market correction feels like failure. So instead of building emotional endurance, many beginners become trapped inside constant reactive monitoring. Then came the fourth domino. The market experienced massive periods of speculative mania that convinced millions of people wealth creation was supposed to happen quickly. Meme stock explosions, pandemic-era trading surges, crypto booms, option speculation, entire communities celebrating massive gains achieved in days rather than decades. And during those periods, patience started looking obsolete. Slow investing began feeling stupid. Why steadily compound at 8% annually when social media keeps showing people making 300% in a month? That single question quietly corrupted beginner expectations everywhere, because the historical reality of wealth creation became emotionally incompatible with the speed modern culture now expects from almost everything. Fast entertainment, fast shipping, fast validation, fast success. So beginners entered the market believing investing should feel fast too. But markets eventually punish impatience. Always. And when reality finally slows down again, when compounding returns to its natural pace, beginners emotionally collapse. Not because the market changed, but because they unknowingly built their expectations during an abnormal period of financial stimulation that was never sustainable to begin with. At the center of this entire problem is a psychological mechanism most beginners never realize is controlling them. The market exposes people to delayed rewards while simultaneously surrounding them with immediate emotional comparisons. And human psychology handles that combination terribly, because the beginner is not only fighting the market, they are fighting their own time perception. Real investing operates on delayed gratification timelines, years, decades, sometimes entire economic cycles. But modern culture conditions people to expect visible progress almost immediately after effort begins. Go to the gym for 2 weeks, expect changes. Launch content online, expect views. Start a business, expect traction. Invest money, expect growth. So when beginner investors encounter the actual speed of compounding, their brain interprets the experience as failure, even when everything is working correctly. That's the frozen mechanism. The market moves too slowly to emotionally reward beginners early enough to keep them psychologically committed. And because beginners don't receive immediate emotional reinforcement, they start searching for faster pathways. This is exactly when dangerous behavior begins. The beginner stops asking, "How do I build wealth steadily?" and starts asking, "How do I speed this up?" That single shift changes everything. Suddenly, boring index investing feels inadequate. Long-term strategies feel emotionally unsatisfying. Patience feels passive, and speculation starts looking intelligent, because speculation promises emotional acceleration, more movement, more excitement, more visible outcomes. But there's another layer most people completely miss. The beginner is usually not actually chasing money. They are chasing proof. Proof that they are smart, proof that they are progressing, proof that investing is working, proof that they are not falling behind everyone else online. And because long-term investing produces very little visible proof in the beginning, many beginners emotionally abandon the strategy before compounding has enough time to become noticeable. This is why the early years of investing feel disproportionately difficult psychologically compared to later years. At first, the effort feels enormous relative to the visible results. Someone invests consistently for 12 months and barely sees meaningful change. But years later, the exact same habits suddenly start producing dramatic portfolio growth because compounding finally becomes visible. Most beginners quit in the invisible phase. That's the tragedy. They leave before the mathematics become emotionally convincing. And the market quietly exploits this weakness over and over again, not intentionally, but structurally. Because the stock market transfers wealth disproportionately toward people capable of tolerating delayed gratification longer than everyone else. That's the real advantage wealthy long-term investors often possess. Not secret stock picks, not superior intelligence, not magical prediction abilities. Emotional endurance, the ability to continue behaving rationally during long stretches where success feels invisible. In a world addicted to immediate feedback, that ability is becoming increasingly rare, which is exactly why so many beginners emotionally tap out long before the compounding machine ever has the opportunity to fully activate. Imagine a 26-year-old named Austin. He starts investing during a major bull market. At first, everything feels exciting. He downloads a brokerage app, watches investing videos every night, joins online communities, and starts believing he's finally entering the world of wealth creation. His first investments go up quickly. A few stocks jump 20%, one doubles. Every gain feels like proof he has talent. And without realizing it, Austin slowly stops viewing the market as a long-term compounding system. He starts viewing it as a personal intelligence test. That's where the danger begins. Because once investing becomes tied to identity, emotional decision-making intensifies dramatically. Austin begins checking his portfolio constantly. At work, in bed, at restaurants, during conversations. Every green day boosts his confidence. Every red day quietly attacks his self-worth. Then the market changes. The easy gains disappear. Stocks become volatile. Some positions drop 30%, then 40%. And suddenly Austin experiences something nobody prepared him for. The emotional humiliation of being wrong publicly and privately at the same time. The portfolio that once made him feel smart now makes him anxious. He stops opening the app as often. Then starts panic-consuming financial content, searching for certainty. Different influencers tell him contradictory things. Buy the dip. Sell before it crashes further. This is the next opportunity. The economy is collapsing. His emotional state becomes completely tied to market movement. And eventually the pressure becomes unbearable. So, Austin sells. Not because the long-term thesis failed, not because compounding stopped working, but because psychologically, he could no longer tolerate the gap between what investing actually feels like and what he expected it to feel like. Months later, the market recovers without him. Years later, many of the assets he abandoned continue compounding upward. But Austin now tells people, "I tried investing once, it just wasn't for me." That sentence hides an enormous tragedy. Because what failed was not his ability to build wealth. What failed was his psychological framework, and Austin is not unusual. Millions of beginners go through nearly identical emotional cycles. Excitement, overconfidence, constant monitoring, emotional attachment, volatility shock, confusion, panic, exit, then quiet regret while watching the market continue upward without them. The market doesn't just test financial knowledge. It tests emotional stability under uncertainty. And most beginners enter completely unprepared for that reality because modern investing culture markets outcomes aggressively while almost never discussing the psychological endurance required to survive the process long enough for those outcomes to arrive. That's why so many people quit too early. Not because the market is impossible, but because nobody warned them that successful investing often feels emotionally uncomfortable long before it feels financially rewarding. What makes this problem even worse for modern beginners is that they are trying to learn patience inside an economy designed to produce financial urgency constantly. Previous generations often entered adulthood during periods where housing was cheaper relative to income, education costs were lower, and basic financial stability felt more attainable through ordinary employment. That environment naturally gave people more psychological room for long-term investing. Today, many younger investors experience the exact opposite. They enter adulthood carrying student debt, facing extreme housing costs, unstable job markets, rising living expenses, and constant economic uncertainty, which means many beginners are not approaching investing from a position of patience. They are approaching it from a position of financial pressure. And pressure completely changes investor behavior. Because someone calmly investing for retirement over 30 years behaves very differently from someone subconsciously hoping investing will solve immediate financial anxiety. This is one of the hidden demographic shifts reshaping modern investing psychology. Large numbers of younger investors are emotionally desperate for acceleration. Not because they are greedy, because traditional financial milestones increasingly feel delayed or unreachable. Home ownership feels distant. Retirement feels uncertain. Stable middle-class lifestyles feel more fragile. So investing quietly transforms from long-term wealth building into perceived escape velocity. The beginner is no longer simply trying to compound money. They are trying to catch up to an economy that already feels ahead of them. That desperation creates enormous vulnerability to unrealistic expectations. Suddenly, slow and steady feels emotionally insulting. A strategy producing reasonable long-term returns feels inadequate when someone believes they are financially behind before age 30. This is why speculative investing narratives spread so aggressively among younger demographics, not simply because people want wealth, but because many people feel time pressure economically for the first time in modern history at such young ages. And social media intensifies this constantly. A beginner no longer compares themselves only to neighbors or coworkers. Now they compare themselves against millions of curated financial identities online. 23-year-olds claiming financial freedom, day traders posting luxury lifestyles, crypto millionaires, entrepreneurs discussing seven-figure exits. Entire feeds designed to make ordinary financial progress feel painfully slow. This creates what I call timeline distortion. The beginner starts believing wealth should arrive dramatically earlier than compounding historically allows for most people. And once timeline distortion enters investing psychology, patience starts feeling like failure. That's the real danger. Because long-term investing only works if someone emotionally survives the middle period where life still feels financially difficult, while wealth is compounding invisibly underneath. But many beginners now abandon the process during that middle phase because culturally, they've been conditioned to expect visible success almost immediately. And ironically, that impatience often delays wealth even further. Because the people who build lasting financial security are usually not the ones chasing rapid transformation. They are the ones emotionally capable of surviving slow transformation longer than everyone else. One of the biggest reasons beginners quit too early is because they misunderstand what market crises are supposed to look like. Most people enter investing believing crashes are signs the system is broken. But historically, crashes were never the exception. They were part of the mechanism. Every generation experiences moments where investing temporarily feels irrational, dangerous, and emotionally unbearable. The Great Depression, the 1970s stagflation era, Black Monday in 1987, the dot-com collapse, the 2008 financial crisis, the pandemic crash. At the time, each event felt catastrophic to the people living through it. And during every major downturn, millions of investors became convinced this time is different. That phrase appears constantly throughout financial history. This time the market won't recover. This time capitalism is failing. This time the economy is permanently broken. And emotionally, those fears always feel convincing in the moment because human beings naturally confuse temporary uncertainty with permanent collapse, especially when money is involved. But here's the uncomfortable historical reality. The investors who built extraordinary long-term wealth were usually not the people who avoided every crash perfectly. They were the people who survived emotionally long enough to remain invested through multiple crashes without abandoning the process entirely. That distinction matters enormously, because beginners often imagine successful investors as people who calmly predict everything correctly. In reality, many successful investors simply develop tolerance for periods where markets looked frightening temporarily. And this is where the stock investment fantasy collapses again. Beginners expect investing to feel validating most of the time. History shows the opposite. Long-term investing regularly forces people to continue acting rationally during periods where emotional instincts are screaming to stop. That's why downturns expose the difference between theoretical investors and actual investors. When markets rise steadily, everyone feels intelligent. Everyone believes they have conviction. But crashes reveal who was emotionally prepared for volatility and who was secretly expecting smooth upward progress the entire time. And ironically, many beginners quit during the exact moments long-term investors quietly build the most future wealth. Because market crashes create psychological discounts most people are too afraid to use. Prices fall, fear rises, news becomes apocalyptic, social media fills with panic, and beginners interpret the emotional intensity as proof they should leave. Meanwhile, disciplined long-term investors often continue buying through the chaos, precisely because they understand something historical data shows repeatedly. Markets recover long before emotions recover. That's one of the hardest lessons in investing. The emotional environment almost always looks worse near major financial opportunity. But beginners rarely have enough historical perspective to understand that in real time. So they exit emotionally, wait for certainty to return, then re-enter after recovery already happened again and again. That cycle quietly destroys enormous amounts of long-term wealth. Not because the market failed, but because fear convinced people temporary pain meant permanent danger. And history shows this pattern repeating across generations almost identically every single time. So if most beginners quit investing too early because reality violates the fantasy, how do you avoid becoming one of them? The answer is not finding better stock picks. It's building a psychological framework strong enough to survive long-term compounding. And that starts with changing what success means in the beginning. Rule number 1. Stop measuring investing by short-term emotional rewards. A good month means nothing. A bad month means nothing. Even a bad year often means very little in the context of decades. Beginners destroy themselves by emotionally zooming in too far. Long-term investors zoom out. Rule number 2. Treat investing as a system, not an event. Most beginners secretly expect investing to create transformation quickly. But wealth is usually built through repetition, not dramatic moments, consistent contributions, consistent patience, consistent emotional control. The system matters more than temporary outcomes. Rule number 3. Expect boredom early. This is critical. If your investing strategy constantly feels exciting, there is a high probability you are taking far more risk than you realize. Real long-term investing often feels uneventful for long stretches. That's normal. Boredom is not proof the process is broken, it's often proof speculation has not hijacked your psychology yet. Rule number 4. Reduce unnecessary portfolio monitoring. Constant checking creates emotional volatility even when long-term progress is perfectly healthy. The more frequently beginners monitor investments, the more emotionally reactive they become. Long-term wealth rarely requires hourly attention, but emotional panic does. Rule number 5. Build historical perspective intentionally. Study previous crashes, previous recoveries, previous bubbles, because history trains emotional resilience. Once you understand that fear, volatility, corrections, and crashes are recurring features of markets rather than shocking anomalies, temporary downturns become psychologically easier to survive. And finally, separate investing from identity. Your portfolio is not proof of your intelligence, not proof of your worth, not proof of your future. Markets fluctuate, sometimes irrationally, sometimes violently. Long-term investing only becomes sustainable when someone stops tying emotional self-worth to short-term market movement. Because the people who quietly build wealth are often not emotionally stronger in every area of life. They simply learn how to stop demanding immediate emotional validation from a process built entirely around delayed rewards. That's the real shift. And once you understand it, the stock investment fantasy starts losing its power over you. You stop chasing excitement. You stop expecting instant transformation. You stop confusing activity with progress, and slowly, you begin behaving like the type of investor compounding actually rewards over time. Because in the end, the market does not usually reward the smartest person. It rewards the person who can remain rational, patient, and emotionally stable long enough for time to finally do what beginners always expect speed to accomplish. Thank you for watching, and if you like this, you can comment, like, share, and subscribe for more.